Josh Levitin, one of Fausto's day trading instructors here with CTU. Let me just get a quick sound check first so I know you guys can hear us loud and clear. Just type a quick Y if you have, if you guys can hear us loud and clear. All right, perfect. Quick question from Ardeen. I have an emergency. I have to leave early. Sorry to miss this. No problem, Ardeen. Listen, we have this recorded. This will be available for you, like I had mentioned in the chat board. I would say by Thursday, the absolute latest this week. It will be on our YouTube channel. I would also check DTI as well. They will have the recording for viewing as well later. All right. Well, good to see you guys again back here as well. Hanif, Ardeen, James, TJ, Jerry, Ted, Eric, Leda. Good to see you as well, Leda. All right, guys. Well, welcome, like I said, to our Closing Bell webinar. And today we have a fantastic guest for you guys, a real special treat. Good friend of ours, good contributor here, not just with Cyber Trading University, but both Tom and our presenter today, Chuck Crow from DTI. They have both been on our Cyber Expo webinars that we do once a month, or I should say once a year. So great, fantastic guest with us today, Chuck Crow from DTI. Now, what Chuck will be going over with you essentially today is much like it says on the webinar topic title, the seasonal trades for the summer. So obviously, as everyone knows, going into the market season, going into the summer, I should say, the market volume altogether dies down, and the trades are harder to find, whether you're an options trader, futures, forex, and especially the equities market. We all know that. So what Chuck will be going over with you today is essentially that. Understanding, obviously, just easily spotted market reversals, a good resource for timing entries. So that's what he'll be going over with you today. Now, just to give you a quick introduction as far as who Chuck is, of course, not just a good guest and contributor with CTU, but he's actually one of Tom Busby's original employees there at DTI. Been trading side by side with Tom for a long while now, actually. He's been working with DTI since early 1996, so almost coming up on 20 years with DTI, one of the original traders with them. So he has written DTI's pre-market planner since 2001. He currently hosts the Night Owl. He instructs their students on what to look for during the night market and obviously going into the next trading day as well. So now is the best time to present this, Chuck. Are you there?
Yeah, Josh, I am here, and I think the sound's coming through okay. How are you guys doing this evening?
Sounds coming in perfect, Chuck.
All right. Well, I guess we're ready to get started then. Uh, Guys, the way I do presentations, I'm a bit more informal than what you might be used to. So I'm going to get the slides out of the way here. This is what was put together for me, which is kind of interesting because it doesn't actually match up what our topic is here, but we're going to put both of them together. First of all, you got to do a risk disclaimer, right? We all have to put that out there. There's a very high degree of risk involved in trading. Past results are not indicative of future result or future returns. Um, all the little things that you have to put in. There is risk in trading. Imagine that. So despite whatever anybody tells you, you always have risk. DTI, we were founded in 1996 by Tom Busby. This is a picture of our building here at 1555 University Boulevard in Mobile, Alabama. And it doesn't quite look that pretty, probably needs to be whitewashed. But that's the way the building looked back in 1996. Actually, I think that was closer to 1999. In that picture, yeah, there may be a little photoshopping there. But still, a nice little brick and mortar building here in Mobile. Now, what I typically talk about is key numbers in the market, and we're going to go through using the roadmap software to look at that. You don't see the photo. Hang on. We're on the wrong page. Let me get you over to screen sharing. All right, can you see my images now? All right, so DTI. Let's switch over here. Risk disclaimer. I get that switched over. Here's your picture. And what I typically talk about is key numbers in the market. We're going to go through that, find a way to use them in a I can't speak, seasonal pattern. There you go. All right. And also, I just want to go ahead and let you know we've got a Saturday presentation, Fed Prep market numbers you should know. That's going to be going on. So that page is there. And let's see, let me just do this. I'm just going to quickly, Josh, I know this is a little bit, but I'm going to go ahead and put this link in the chat room. You guys can reference it back if you like, or if that's a no-no, Josh, you can go ahead and delete that. Um, moving down on the slides, questions, you can send an email to me, crow@dtitrader.com. All right, done with the slides. Let me get you to DTI's roadmap software. We're just looking at Yum Brands. We do a stock of the day, and someone suggested looking at Yum. I thought Yum is a great stock. Anybody owns stock in Yum? That's the KFC, Taco Bell, Pizza Hut group. Now, with the DTIC, we get to see some of the seasonal patterns that exist within this particular stock. And if you look here, imagine this. This is a big stock that essentially is a sell in May and go away type stock, right? Can you guys see these numbers in here? Percent P&L by month. So if I'm looking at Yum Brands, I love what I'm seeing with the stock. I think it's a great one to own. It's got the diversity in the uh, fast food business. I like the fact that it's chicken. I guess we call it Tex-Mex and pizza, right? So you got several different things here. It's not like a McDonald's where you're just hanging on to that one company. We have a couple different options. So if tastes go one way, then you can sort of swing that, offset it with the other two brands. If they go the other, you've got kind of an offset there, a nice little diversity. But like many stocks, June, July, August, not great months. January, not a great month either. But this is a stock that typically climbs in February, March, April, and May. And well, I think we got a little bit of that action this year also. Now, September, October, November, also pretty good months. So probably the best time to invest in a stock like Yum Brands. Probably may not want to be invested in them right now, although everything about the stock looks great. But if you come back at the end of August, think about this. And this is an important consideration when you're looking at investing in a stock with particularly Yum Brands. When do you typically order a pizza? What's the main reason for having a pizza delivered to your house? I get it, some people have Friday night pizza night, but most people, what are you looking for? It's kind of a party atmosphere, right? You don't want to be tied up in the kitchen. You want to be paying attention to something in your house, maybe the TV. Why is September the turn here on the seasonals? Well, part of it has to do with sports. What happens in September? You get into NFL and college football, right? A lot of people will be ordering pizzas to watch the game, or perhaps ordering wings or whatever your choice of food is. So fast food and delivery in particular kind of picks up typically in September. So that's one of the things that I would expect to see with that particular stock. That's just an example of what we can do with the seasonals here. And I'm going to take you through now and just show you some of the big numbers that exist in the index markets, which is kind of where this is where my forte is. So I've got a couple pages that I use within the roadmap software, and I'm going to break these down for you. The first page here is a statistics page. It's showing me the simple moving averages for any market I choose. I've chosen the E-mini, S&P, Dow, NASDAQ. The XG here is the DAX futures traded out of Frankfurt, Germany. EX is the Dow Jones Euro Stocks Top 50 Index. And the TFS here, that's the Russell 2000. And I'm looking at a few things, the SMAs, the ATRs. I can also go into average volume, past 5 days, past 20 days, and just kind of keep track of how the markets are moving here. Like the S&P has an average range of 21.35. And when we take a look at its range today, let me pop over, let's see, daily range. We went up to 21.18, down to 21.0650. So that's well below average in terms of the range, which I guess is kind of to be expected. We're moving in towards rollover. We got a big Fed day coming up next week. So there's a lot of things on the calendar coming up from a futures trader standpoint. expiration is a week from Friday. So a lot of stuff going on there. We're looking at smaller ranges right now. In terms of the weekly performance, I use my daily targets page. These are your weekly opens. S&P futures 9750, Dow 17808, Nasdaq 4511. And what we do is we take the average ranges for those time frames, which are based on these numbers over here. But a week comes out to an average of 55.1 range. That's over a 20 period time set. So basically 20 weeks, we've been averaging 55 points per week. Now, given that, we would expect that the market is bullish above 2111 and bearish down at 2083. Now, if you studied the S&P well enough, you know that last week's low was actually 2082.75. So that number matches up pretty well. And there's another number that matches up right around this 2111, which I'm going to get to in just a second. Down below this, you can see the monthly time frames and the quarterly time frames. So we can actually project out what to expect in terms of support and resistance given these average range numbers over several different time periods and see how the markets are lining up. You'll notice the color coding here. The green numbers mean that we're above those bull numbers. If we had a red numbers, we'd be below the bearish lines. And the yellow numbers are the market still in a neutral zone in between that support and resistance. When I come over here to the research key, and this allows me to have several different symbols, and I want to go back. I always like to use a continuous symbol when I'm looking at a futures contract because I like to do a lot of history. This is a quarterly image. So I've clicked on the quarter here, and if you follow these markets, one thing that we've been doing within this second quarter of 2015, we've been taking out numbers. And you'll notice from the fourth quarter, or this is actually the third quarter of 2015, the market started making lower highs. And it's kind of a big deal. We go through the first quarter, and everybody's a little bit scared of the market. We ended up closing the first quarter back in a little bit of a positive range there at 2051.50. But it was kind of a scary market. We got down to 1802.50. Those highs keep dropping. And in this second quarter of 2016, the market has made its mission to take out all the upper numbers. First of all, we break 2064.50. We did that early. Earlier this week, we got above 2110 quarter. So when you look at a market like this, the big question, what's the next number? So you guys tell me, you're looking at the same screen I am, and I want to make sure you're still paying attention. So what do you think, based on what you're seeing on this screen, hint, hint, is the next big number for the S&P futures to try and take out? Anybody have an idea? And you can do this with any stock as well. I just like using the S&P to make the point. I want to figure out who all's paying attention right now. Not that many people, apparently. Okay, Edward's got 2118, which is a good thought, Edward. Basically what you're doing is you're looking at that first number here. That's the high of the present quarter, and it's certainly a number that we're looking at. But it was set just today, so it's not really in stone there. Rodney, exactly, that's spot on. 2126, if you look down the list here, the 10 quarter number was lower than the 2126 quarter number. So 2126, the next number that you're looking for the market to try and take out. And part of bullish markets and bearish markets for that matter, part of every market is momentum. And so the way you build momentum is you take out number after number after number, because when you take out a big number, what you end up doing is you're hitting stops on the other side. So when we break a big number, a number that's been sitting out there for a while, when we break above it, we're expecting to hit a lot of stops. So if I'm in a short position, for example, then I'm saying that the market should not get above 21.26 quarter. So if I have a short position there, I've got a buy stop above 21.26 quarter, which means that the market goes above that, then me as a seller, I've got to close out my position. So I become a buyer. I add to the upside momentum. And if in my mind I'm thinking that the market's going higher above 21.26, that's why I don't want to be short anymore, then I also want to go ahead and buy for position to open up a position to take advantage of the market going higher. So when we break some of these big numbers, we create momentum and acceleration. So that's what you want to pay attention to. That's not always going to be the case, but that's what's expected. So we always want to be aware of where these numbers are located. And the next big one is at 2026. And the one after that, we'll just go down a little bit further, would be at 2134. And the big deal with 2134, that would be the all-time high in the S&P futures. Now, how far do you go after that? The catch is when you make an all-time high, the market gets a little bit scary because it doesn't have a number to go challenge. Right now, we got above 10 quarter, and you can see the market pushing and pushing, gets up to 21.18 today. Basically makes half that distance between 10 and 26 in one day, right? You had an 8-point rally, 8 more points, and you're at 21.26. So if I get above 34, where am I trying to go to? Well, we really don't know. So as long as I've got numbers I can pay attention to, I have a reasonable expectation of what to see within that market. Now, if I go over to, let's look at the Dow futures. I know many of you are interested in the Dow Jones Industrial Average. Not all of you are futures traders here, but you see that same type of pattern. See these red numbers right here? This is the third quarter, the fourth quarter, and the first quarter of 2015. So, or excuse me, third quarter of 2015, fourth quarter of 2015, first quarter of 2016. So those numbers all going down. And notice this quarter, we've actually been up to 18,083. That wasn't set today. That was set back in, let me take a look at the monthly numbers here. The 18,083 was set in April. You go to the quarterly numbers, and the next big rally is up to 18,334. You got a couple numbers here that you can pay attention to, the 18,270. But the market had already been above 18,075. You guys notice that the Dow seems kind of lackadaisical lately, not really wanting to jump on board with the big runs that we've seen in the NASDAQ or the big runs in the S&P. Those two going kind of back and forth, bullish one day, bearish the next, and the Dow's just kind of sitting in the middle, except for the big sell-off it had at the beginning of last week, coming back from the holiday. But have you guys noticed that? The Dow not really got anything. Well, part of that is because it already broke the number. So when you look at a market, whether it be an equity market or an individual stock, you're always looking for a reason for the market to move. So it's not just about seasonality. Sometimes it's about motivation. Okay. So let's do this. I actually planned on doing about a 15-minute presentation, which we're 20 minutes in, and I notice we've got on the schedule here about an hour. So let's do this. Is there any stock that you guys want to look at from that seasonality standpoint, from these big numbers standpoint? Okay, JCP from Peter. All right, let's start with JCP. And I'll come back and ask for more in just a second. What I'm going to do here within my roadmap software, I'm going to add a symbol. And let me be perfectly clear. I know Fausto does a lot of trading. I'm sure Josh and Eric do as well. What I'm talking about here are big picture things. It's not necessarily what these guys might be looking for an individual trade. So I want to say that up front, because there may be some contradictions when we start breaking down the numbers. JCP, well, as far as targets, this stock has been moving up during this time frame, and yet it's also been moving down. So I've got an expanding range here. See how the highs and lows, the highs are increasing and the lows are decreasing at the same time. Oh joy, that's one of those things where if you like volatility, Peter, that stock is shaping up to be a little bit volatile. And JCP, is that JC Penney? I'm not familiar with the stock, but just looking at those numbers there, these are basically outside bars. We're making higher highs and lower lows, and we've been doing that since the second quarter of 2015. So as far as targets go, really everything's inside. Now, we currently have a low for this quarter of 710 versus a $6 low for the previous quarter, a high of 1113 versus an 1199 high for the previous quarter. So that's not really showing me all that much. But let me go back and look at this from the seasonality standpoint. JCP and retails have always been tough for me. I'm not a big retail fan. But let's go and look at the DTI panel here. And you see this expected seasonality, expected things to go higher, at least into April. Sell in May and go away big time on this particular stock. A little bit of a bump up in August and September. But as far as an investment, there may be some trading opportunities with that volatility that you see creeping up in there with that range expansion. But as far as an investment, man, I really don't like it. I don't think you've got a great investment plan here if you're looking for something to go higher. Now, there may be some options that we can do on this, but it really looks like if you're looking for an investment, you need to be looking at the end of the year, coming into the first quarter of next year, January, February, March, and April. And of course, one of the big things to remember about seasonality, we don't know the results of the election yet. So we got a few things that are going to change between now and then. If the Democrats win, first of all, I don't care who wins the presidency. I don't think that's the real big issue. It's who controls the House. That's going to be the big issue. So if the Republicans retain control of the House, then you're expecting kind of status quo, no matter who wins the presidency, because I don't know how well they're going to work with either Donald Trump or Hillary Clinton. If the Democrats win the House, then you expect change, especially if you have Democrats in the House and, say, Clinton in the White House. So that would be a big deal. Yeah, Grant, I know, but everybody's involved in a couple of different trading styles. So, but when you're talking seasonally, you aren't talking about individual days. I think that's one of the big things where everybody gets confused. If the market is seasonally down starting in May, the sell in May and go away concept, that doesn't mean that you can't buy on an individual day. Markets are about waves. They go back and forth. So when you're looking at that seasonal perspective, it doesn't dictate what we do on an individual day. And I think that's a concept that a lot of traders kind of get mixed up. The difference between investing, which is very seasonally oriented, and trading, which is really more about moment to moment. Now, you can get sort of a mix between the two when you get into swing trading, do some options plays, take advantage of the seasonality from a trader's perspective. But as far as what do I expect the market to do on an individual day, tell you what, I sold money in the Dow, or sold the Dow today, made a little bit of money, a tiny little bit of money, because it wasn't that big of a sell-off. You can see that market move right here. This is a 1-minute chart. See that little move right there? That was a nice little move. So it wasn't that big of a run, but we did get some movement there. All right, so that's JCP. Sell in May and go away. And from an investment standpoint, looks great January through April. All right, and what else have we got? Looking back, uh, TJ, you asked for TLT. What is TLT? I'm not familiar with that symbol. We'll go ahead and take a look at the history on that. LT. All right, so let's see. We see those lower highs. We also see a bump up in the first quarter, which actually took all those numbers out, 126, 128, and 132. The next big target on the top side would be the 138.50. Your 133.23 is the high of the current quarter. Looks like last traded at 132.56. And TJ, you still with me here? All right, anybody else want to fill me in? TLT. What is that company? I can look it up, but then I gotta go. It's a bond ETF. Okay. First rule of seasonality in trading. ETFs do not necessarily fit that pattern. Is this one of those double weight? I think you have to be careful when you're trying to break down an ETF, especially a weighted ETF, because a lot of these things get recalced at the end of an individual day. So is this basically well, it's a 30-year bond ETF. With TLT, I would think closer to the 10-year note. The one thing I'm going to tell you about bonds is I don't think bonds are necessarily correlated with the market right now. I think when we look at the bond market, it's a speculative venture, more so than just about everything else at the moment. Because effectively, with the Fed being where they are, everything is dependent on news. At the Fed, I mean, we're paying attention to Janet Yellen receiving an award from a college. That's a news event, TJ. So I look at the bond market and I say, you know what? I'm going to step back away from the bond market because it's not quite the organized type of bond market that I grew up trading, that I was familiar with in this business trading. It's different. It just is, and I think as long as the Fed funds rate is as low as it is, it's just going to be different. What I'd want to see before I really get back into the bond market from a trading perspective, I'd want to see that 10-year note climb closer to a yield of about 3.5%. Because if you look right now, the average yield in the DJIA, Dow Jones Industrial Average, is around 3%. And the average yield on a 10-year note, or the yield on a 10-year note, I think is right around 2%, maybe a little bit below that. Now, those percentages really skew things because typically you want to see the yield on the bond be at or better than the average dividend yield coming out of a stock. Average, and obviously some stocks are going to have better yields and some stocks worse. But if the DJIA average is greater than the yield on the 10-year note, things are a little bit messed up. Everybody's saying, well, why is the market going higher? It doesn't make any sense. Really? If I can make 3% in the Dow or 2% in the 10-year note, where would you put your money? You like 3% or 2%? You want to make more or you want to make less? So I think it kind of messes up what we're looking at in the bonds and some of those traditional relationships. And the catch is, while it has been that way for a while, it's going to change. We're just not sure when. So everybody's paying attention to when it's going to change. So I think that the bond market is, I look at that seasonality. It's really not telling me what I'm looking for. But you will notice October. See that big down move? That big down seasonally? That might have something to do with last year when the Fed, during the October meeting, essentially said that they were going to be changing rates in December. By the way, they did not say in the April meeting that they were going to be changing rates in June. I just want to put that on the table right now. That's something we'll talk about more on Saturday. But you can get an idea of what the Fed's going to do, and I think that's creating change. Now, what really bothers me is not so much the Fed says and then the market does, but I think there's way too much attention being paid to the Fed at the moment, and it's because of where rates are. If rates were up around, if the Fed funds rate was around 2%, we wouldn't be paying as much attention to the FOMC. More particularly the FOMC members. If you happen to be a member of the FOMC, please understand, everybody's watching everything you do. Okay, if you go out to get the newspaper at 6 a.m. instead of 7 a.m., they're going to think it might mean something. Ooh, he's up early. Maybe that means they're going to change rates in June. I think it gets a little bit ridiculous. And because the coverage of that gets a little bit ridiculous, it really makes trading in bonds a bit of a headache. So my standpoint on bonds is, you want to trade them? Have fun. I'll wait until they normalize a little bit. You know, it's a volatile market. There's a lot of money to be made, but there's also a lot of money to be risked. And I don't know if this seasonality is really telling me a true story out there. So I would be very, very careful in the bond market. I know that's not the answer that you want to hear when you come in looking for seasonality, and I ask you what stocks you want to give me, and you give me one there, and it's one I'm telling you that I'm not a big fan of. So hope that doesn't offend you. It's just the bond market to me right now is almost the wild, wild west. All right, what was the other one? DDD. Who asked about DDD? DDS. Okay, my bad. And DDS, what is that symbol? Let me go back to my intraday over here. It's taking its time switching over. I'll tell you what, while that's thinking about it, let me get back over here. We'll look at DDS on the research key here. Okay, quarterly moves, and this is trending lower. So it's not turning quite yet. We'll get to Hershey in a second. Peter, what is DDS again? Dillard's. Okay. Department store. Gotta be honest with you, we don't have a Dillard's where I live, so it'd be hard for me to comment on them. Used to have a Dillard's before I moved down to Mobile. Over on the DTIC seasonality, sell at the end of May and go away apparently. October, November, December, that's when you expect things to kind of pick up. January, a little bit off. That's going to be your end of year earnings if the Christmas season doesn't do that well. And even if the earnings are good, but not as good as expected. So it's really tough for a lot of these retails to get good numbers in January because, of course, the expectations are so high with the Christmas shopping season that it's, even when they make the numbers, sometimes they're disappointing versus the street. The street sometimes gets ridiculous. So got to watch out for January in retails. Those earnings don't necessarily come up the way everybody wants. You're in a downtrend in Dillard's. You know, you're trending lower. These quarterly highs are dropping. The quarterly lows are dropping. What I would look for is, where does this thing start to turn around? Now, looking at the monthly view, you got a little bit of a turn in February and March, getting up to 85. Couldn't quite get back to that 91.22 number, and you can see the way everything is streaming down from there. Watch out for support at 54.37. And if it starts to turn around, which I don't know that it will, but if it starts to turn around, the next number to break, first of all, that's 72, but then the quarterly number 85. Those are two top end numbers that I would keep an eye on. But of course, as we looked at with the seasonality over here, summertime is not really a time for Dillards to turn around. But September, that's seasonally when things sort of stop. And if you think about it, if I recall correctly, Dillard's is one of those places you go shopping to get the kids ready to go back to school, right? Outfits and all that kind of stuff, kind of like a J.C. Penney. And when do you generally go shopping to put the kids back in school? See, some of this seasonality stuff can be common sense. Actually, I'd refer to it as market sense. You take what you know is common and you apply it to the market. But a lot of times it is, when you're looking at seasonality, some things just make sense. Big drop today on Dillard's. Well, I didn't know what the symbol was. So, or are you talking about Valiant? In terms of Dillard's, I didn't know what the symbol was. Valiant, that's pharmaceutical, right? So a lot of times that's going to be about news. This seasonality, it's going back about 10 years. I think if you go back further than that, Robert, you kind of get lost in some of the history. Listen, the markets have changed, the way we approach them have changed, the flow of information has changed. What was true 40 years ago is not true today, but what was true 10 years ago, that might be a little bit closer. So I think when you're looking at true seasonality, you don't want to go back too far. You look at the difference between the market we had prior to 2007 when we brought those rates down like we did. It's a completely different market than the one we had after 2009, right? What was true then may not be true now. Now, the catch is when we get things back to normalized, you want to go back and be able to look at what happened prior to 2007 to get a sense of what that seasonality should be. Well, I don't necessarily think it's that way. I think when we look at the markets, one of the biggest thing for me, and I'm kind of going off topic here, so we're kind of getting to the rambling stage. So please feel free to type in your questions. I think we've covered most of the seasonality and just some of the things you can do. And by the way, there are ways to look at how a stock moves up and down. If you don't have this seasonality component, if you don't have roadmap software, first of all, if you want to find out about it, give us a call at 800-745-7444. There you go. But if you don't have it, what you can do is just on any charting program, go in and look at a monthly chart. Hey guys, guess what time's a bad time to be in Dillard's? Last year. But just spread this out a little bit and you can kind of eyeball it and get a sense of where's this a little downturn. This is July. That's June, July, August. Look at that. Right here, that starts in August here. There's August, September, October. And over here, well, the market started coming down. Dillard's started coming down last year in April, but there's April, May, June, July. August doesn't look like a very good month. So we can look at those monthly numbers and just eyeball it on a chart. It just gets a little bit more difficult kind of keeping track of everything. So we've incorporated that DTIC component into our charts here with the roadmap software, which I find to be very good. The webinar mentioned the 7-Eleven rule. Wait a second. Where was the 7-Eleven rule mentioned? The topic listed there is seasonal trades for the summer. I think that was Tom's. And I actually came in, wanted to talk to you about key numbers. The email? Okay. The 7-Eleven rule. That's more of an intraday type thing. Really? He put 7-Eleven with seasonal trades. That's shocking. Okay. All right, so let's look at 7-Eleven. Want to make sure we get all the bases covered. So let's see, 7-Eleven within the roadmap software. And I'll just open this up, show you some of these images right here. What we're looking for with 7-Eleven, we're looking to determine if the market's making a reasonable move away from a high or a low. Now, the 7-Eleven that we're referring to, right-click in here, show you the settings. 7 points in the S&P and 11 points in the NASDAQ. Now, you got to be careful with this because markets do change. The evolution of markets are a little bit different. 7-Eleven is a good place to start, but it's not the only place. So what we want to see is, does the market travel away from either the high or the low? And I'm looking at both the S&P and the NASDAQ to see if I can get that determination, get an agreement between the markets. So the 7 points is in the S&P futures. If I'm dropping 7 points below the high, and you can see the 2118 high there, and at the end of the day, we were coming down. We hit 2111. We actually just last traded at 2110 quarter. Let me pop back over here and get this chart changed back over. E-mini S&P. Go intraday. And the point at which you really expect this market to let go. Now, it's been a tighter range than what you would expect, but from 2118, I want to come down 7 points to 2111, which actually doesn't give me much because the market goes down to 2110, bounces back to 2111.75. So there really wasn't much of a move there. But on the upper end, 2109, 7 points higher, you're looking for, let's see, what's 9 plus 7? 16. So when we got above 2116, and again, not much going on in the market on that one, but that's little areas that you look for acceleration. Now in the NASDAQ, those point values are going to be at 11 points. Let me switch this over to a 30-minute chart for the NASDAQ. And the NASDAQ, you'll notice, coming off of the low, we're down here at 45.17, so 11 points higher would be 45.27, and you can see 27, the high of this bar right here. We come up to 27.75. You get a little bit of an acceleration, but not really a whole lot. Do I ever look at the Russell for some guidance? You know, I used to, Robert. I'm not the biggest fan of the Russell right now. I got to be honest with you. We did a lot of work with the ICE early on. They're great people over there. But when they took the Russell and moved it away from the CME, running the same hours as the S&P, the NASDAQ, the Dow, and moved it over to the ICE, put it on separate hours, and then started trying to charge, what is it, like $100 per month to be able to look at the Russell? Which actually you can make $100. It's $100 a point, so you can make that up pretty quick. But what I don't like about it, it's not necessarily the cost of it. It's the fact that it runs on different hours, and so sometimes it's a little bit hard to make that connection. I think the Russell's a great market, but it doesn't necessarily move with the Dow, the S&P, the NASDAQ. So I think that kind of hurts it a little bit. I think it's a market worth paying attention to for some guidance, but I can't always trust it. It's like you ever see those parents walking through the mall with the little kid? If you're trying to look at that little child to determine the direction the parents are going, you may be making a mistake. The little child tends to be a little bit rambunctious. Run here, come back. Run over here, come back. Run over here, come back. If you're trying to figure out where that group is going, pay attention to the parents. And in the case of the market, the parents, the big daddy is the E-mini S&P, just on sheer volume. So yeah, the Russell's nice, but it doesn't always show me. Eventually that kid runs off to a position where the parents got to go out and chase him. Yeah, the Russell is the wild child. So sometimes it's a great forward indicator. Other times it's kind of a misleading indicator. So I think you got to be very careful if you're using the Russell as a primary indicator. Now, paying attention to it makes sense. All right, I think I'm getting messages over on my other screen. They're probably wondering where I am. The 11 part in the NASDAQ, I think, Stan, going back to that, was it Stan? Yeah, Stan, going back to that. 11 to me is a little bit, I think it's a little bit small for the NASDAQ. I think the NASDAQ's a bigger market than that. But you can see that we hit the 27, and coming down from the 27, 11 points below 27 would be, if I'm doing my math right here, that would be 27 minus 11. Come on, brain. So 16. And not really much there. So when I'm looking at that 7-11, I'm looking for big moves in the market, but I also have to consider what kind of market I'm in. And we've been in rather tight markets this week. So without a real expansion of the range, it's kind of hard to use that 7-11. I think when you get into the 30-40 point range for the S&P futures, the 7-11 really comes in handy because you're going to see those trend changes. But right now, you really have to pay attention to where you are. A market that tells me, for instance, with the S&P, hey, if we get below 2111, we're going to have a big move down. But then I go back to those numbers that I want to pay attention to. I got a big one there at 2110 quarter. So if I get below 2111, where am I going to? I'm going to 2110 quarter. Is it really a trade I want to take? Yeah, I think I can leave that one on the side. All right, so help me out. Was there anything else in the ether? If you guys come to hear a certain presentation, that we at least cover the topics on that presentation? I think for the most part, we're just about done here. I'm going to leave that to Josh and Eric. I think Eric said, or no, Josh said before that it will be posted. There you go. Thank you, Eric. And I think we're pretty much done here, guys. Let me go back into the slides and give you a quick reminder. Hope that I can do this. On Saturday, and this will be Saturday, June 11th, we're going to be doing Fed prep and market numbers you should know. You've heard some of the market numbers here today, but I'm going to take you through trying to decipher what the Fed says. So that'll be a lot of fun. That'll be Saturday at 10 a.m. If you're not sure, you can call 800-745-7444 and ask about joining the Saturday presentation for DTI. But since this is being recorded, that's not very evergreen. So if you're listening to the recording on Sunday, June 12th, forget about a Saturday, June 11th presentation. I think Janet Yellen can make a decision just fine. The question is, can everybody else stop second guessing her and making her look like a fool because they don't know what the hell they're talking about? Ooh, whoops, that might have been a little bit overboard. Yeah, listen, when you second guess the Fed all day long, and then they don't do what you guessed, is that their issue or your issue? I think it's more your issue, and really it's the media and how much attention we pay to them. Listen, when they make a decision, if you just pay attention to the FOMC announcements, forget about everything else, they aren't quite as aggravating. If you're listening to every single speech done by Janet Yellen over the course of a year, it's going to be ridiculous. So I think there's way too much attention being paid to them. These are the times when you should pay attention to the Fed. FOMC days, which are 8 times a year, Humphrey Hawkins testimonies, which are twice a year. If you're talking about the Fed on more than those 10 occasions, then you're paying too much attention. Well, Lee, the same question was asked about Ben Bernanke, about Alan Greenspan, about Eric Volker. Keep going back and back and back. And it's amazing how smart these people actually were when the next person's in the position. It's one of those positions where if you're the one in the seat, you're dumb. If if you're one who was in the seat before, then you're brilliant. And that's just the way history remembers these people, and it's the way that the past remembers them. Um, it's a difficult job. It really is. But I'd say wait till the end of her chairmanship, let a little time go by, and then we'll talk about how smart she actually was, or how how ineffective or how effective. I think history is the real. That's really where we get to see about these people who are in charge of the Fed. That's really where we make those judgments. All right, and I think that's going to wrap us up here today. I think I've run out of information. I'm going to get into um, a little back and forth, which might not be appropriate for a recording. So let's go ahead and stop our webinar here today. I want to thank everybody. You guys asked some great questions. Thank you for your participation. And I think that's about it. Hope to see you guys next time. And looking forward to seeing Fausto hanging out at DTI. Is that tomorrow? Josh and Eric? I think that's tomorrow. Okay, great. Looking forward to seeing Fausto there. But for those of you here, thank you very much. Good evening. And have a great weekend or week or whatever.